Coffeezilla says STRC is a Ponzi scheme. Peter Schiff called it the most obvious Ponzi that's ever existed. And then Michael Saylor went on an earnings call and said he might sell Bitcoin to keep the dividends flowing. So is STRC actually a scam? I've been in Bitcoin 13 years now. I've watched countless scams come and go. And after taking a look at this one, I think the critics are missing some important things. In this video, I'm going to go through what STRC actually is, what Coffeezilla got right, where his analysis falls short, and what you need to understand before forming your own opinion. Let's get into it. Before we can evaluate whether something is a scam, we need to understand what it is. STRC is a perpetual preferred stock issued by Strategy, company formerly known as MicroStrategy, led by Michael Saylor. Perpetual means it has no maturity date. Preferred means it sits above common stock in the capital structure but below bonds. If the company were to go bankrupt, preferred shareholders get paid before common shareholders but after bondholders. Investors buy shares of STRC at about $100 per share right now, and in return they receive a variable dividend, currently 11.5% annualized, paid out monthly, maybe bi-monthly soon. Strategy takes the capital raised from selling STRC shares and uses it to buy more Bitcoin. As of early May 2026, Strategy holds about 818,000 Bitcoin worth roughly $65 billion US dollars. That makes them by far the largest corporate Bitcoin holder in the world. STRC itself is scaled to about 8.5 billion in market cap, making it the largest preferred stock instrument in existence. Now, here's what STRC is not. It's not a bond. There's no guaranteed return to principal. It's not a savings account. There's no FDIC insurance, no SIPC protection, and no obligation for Strategy to maintain the $100 share price. And it's not a money market fund, even though some of the marketing around it has used that kind of language. That last point is actually one of the strongest parts of Coffeezilla's argument, if you ask me. We'll come back to that in a second. Coffeezilla's video made a few key claims. First, he compared STRC to Terra Luna. For those who don't know or don't remember, Terra was an algorithmic stablecoin, the worst type of stablecoin, that offered around 20% yields before it collapsed in 2022 and wiped out billions of dollars. Coffeezilla's point was basically, when you see double-digit yields, be skeptical, because historically those kinds of numbers have preceded disasters. And he's not wrong about that. But then second, he focused heavily on the marketing. Saylor has described STRC using phrases like money market-like stability and a bank that pays you 10% interest. Strategy ran ads depicting a retired engineer collecting 11% per year from a beach. On an earnings call, Saylor recommended STRC for your family treasury. Coffeezilla argued that this kind of framing makes retail investors feel like they're parking cash in a safe account when they're actually buying an equity instrument with real downside risk. Third, he pointed out that roughly 80% of STRC holders are retail investors, not institutions. Strategy carries a B- credit rating, which is junk status, and that locks most institutional money out due to their internal mandates. Coffeezilla sees this as a red flag. Now, I want to be clear about something. Coffeezilla himself said in his video, and I'll paraphrase, that he wasn't calling STRC a Ponzi outright. He acknowledged that Strategy discloses the risks in the fine print. The main issue he saw was with how the product is being marketed to everyday people. And that's an important distinction because much of the online reaction treated his video as if he had declared STRC an outright fraud. He didn't. He raised questions about the marketing, and some of those questions are fair. So here's where I diverge from Coffeezilla's analysis. Let's begin with the Terra Luna comparison. Comparing STRC to Terra Luna, because both involve high yields, is kind of like comparing a mortgage to a payday loan because both involve borrowing money. The mechanisms are completely different. Terra Luna was algorithmic, unbacked, and structurally circular. It collapsed because there was nothing real underneath it. STRC is backed by over 818,000 Bitcoin on Strategy's balance sheet, audited by a Big Four accounting firm. You can verify the holdings. They file with the SEC. These are not equivalent situations. To call something a Ponzi, you need to identify the fraudulent mechanism. This is key. A Ponzi scheme, by definition, is a system where returns to earlier investors are paid using capital from newer investors with no legitimate underlying business or asset. And the key word is fraudulent. Operators of a Ponzi scheme lie about where the money is going. Strategy isn't lying about anything. They tell you exactly what they're doing. They sell STRC shares, they buy Bitcoin, and they pay dividends. Every step of that process is disclosed in public SEC filings. You can disagree with the strategy, you can think it's risky or wrong, but calling it a Ponzi requires meeting a specific definition, and nobody in this debate has identified the fraud, Coffeezilla or anyone else. Now let's talk about the math, because this is the part Coffeezilla never really engaged with. Strategy's management has stated publicly that Bitcoin only needs to appreciate at about 2.3% per year for the company to fund STRC dividends indefinitely from existing holdings. They've also set up about $2.25 billion in cash reserves, which covers about 2.5 years of dividend payments without selling a single Bitcoin. Now, is 2.3 annual BTC appreciation guaranteed? No, of course not. Nothing's guaranteed in investing, but for context, Bitcoin's compound annual growth rate, or CAGR, over the last decade has been many times that, much more than 2.3%. And for someone evaluating risk, the break even matters a lot. Coffeezilla never mentioned that, and as for the retail investor concentration, Adam Livingston made a solid counterpoint. Institutional investors are locked behind mandates that require investment-grade credit ratings. Credit agencies currently treat Bitcoin as a liability rather than an asset on Strategy's balance sheet. So the reason institutions aren't buying STRC has more to do with the regulatory frameworks that haven't caught up to Bitcoin than with the product itself being inherently flawed. Now, I'm not here to be a cheerleader for Strategy or to dismiss legitimate criticism. I think they should be criticized. The marketing is the real issue. When you tell people on national TV that STRC is like a bank that pays you 10%, you're inviting people to think of this product as something that's perfectly safe. And it's not safe in the way a bank account is safe. There's no insurance. STRC's price dipped to $90 in November 2025 and $93 in February of this year. If someone bought in thinking it was like a savings account, those drawdowns would have been alarming to them. Saylor is an exceptional promoter, no doubt. That's part of what makes Strategy successful. But promotional language and financial education don't always coexist well. I think Coffeezilla was right to call that out. I'd also add that Saylor's comment during the Q1 earnings call, where he said Strategy might sell Bitcoin to fund dividends, deserves some scrutiny. He later backtracked a little and said the company would never be a net seller of Bitcoin, even admitted the original phrasing was meant to be provocative, just trying to see what the reaction would be. But for someone who built his entire brand on never selling, his diamond hands idea, even floating the idea of selling introduces uncertainty. Let me zoom out for a second, because I think this debate is about something more than just one preferred stock. STRC represents a new category of financial product. Strategy calls it digital credit. And they aren't the only ones building that space. Strive, the company founded by Vivek Ramaswamy, launched a competing product called SATA that's currently yielding 13%. Other Bitcoin treasury companies are emerging, and this is a trend, not just an anomaly. It's not just Strategy. What these companies are doing is taking Bitcoin's long-term appreciation potential and engineering financial instruments around it. They're creating yield products backed by an asset that has historically outperformed everything else over any meaningful time horizon. Is there risk involved? Of course. Bitcoin could enter a prolonged bear market. Capital markets could tighten. Strategy could face a liquidity crunch. All those scenarios are possible and disclosed. But the people calling STRC a Ponzi need to contend with the fact that Ponzi schemes don't file quarterly reports with the SEC, don't hold audited reserves, and don't tell you exactly how the money works. Strategy does all three of those. So where does that leave us? I think Coffeezilla raised some valid concerns about how STRC is marketed. I think the Bitcoin community overreacted to his video with hostility rather than engaging with substance, which happens all too often. And I think Peter Schiff, predictably, took things to an extreme that doesn't hold up under scrutiny. STRC is not a Ponzi scheme. It's a novel, high-risk financial instrument that requires investors to understand what they're buying. If you're considering it, read the SEC filings. Understand that this is equity, not a deposit. Know that the dividend can change or be suspended even at any time. And don't let anyone's marketing, whether it's Saylor's or his critics, do your thinking for you. As always, do your own research. If you found this useful, please share it with someone who's trying to make sense of this debate. Drop your thoughts in the comments. I'd love to hear where you stand on this. Do you think STRC is a scam or not? Hit like if you got something out of it, and subscribe if you want more breakdowns like this. And don't forget to subscribe to the Hard Money Dispatch newsletter. There'll be a link in the description. And I'll see you in the next one.